Mortgage holders are again in the brace position, expecting tomorrow from the RBA a predicted rate hike of 0.25%. The big question is, though, where to from there as we look at various indicators and wonder, is this going to bring inflation under control? Joining me live now is Steve Mickenbecker, Financial Service Executive with Canstar. Thanks very much for your time. Just to start with, I'm seeing a couple of headlines today suggesting even a 0.5% increase today. I've got to say that would surprise me. Where are we headed in the short and then longer term, do you think?
Look, I think 0.25 is something that the RBA is quite happy with, quite comfortable with. They're worried about recession overseas. They're seeing these sort of mixed messages. And I think they're kind of comfortable saying, look, let's edge it up for the next couple of months, maybe 3 months, and see what's happening then. Go too hard, too fast, as they have in some other parts of the world, and maybe recession might come and bite us, and you know, we'll regret that we move so quickly.
It's an interesting equation, though, isn't it? Because a piece of commentary I saw today suggested that it's better going 1 or 2 cuts too far, 0.25 or 0.5, than it is not going far enough and having inflation that won't go away. I mean, it's simple to say, but the problem with going too far is you're putting people out of work. You probably mean some people even lose their homes. So is that a view you agree with, that inflation's the thing to be really scared of?
Look, we do have to be worried about inflation. Obviously, if inflation takes off and runs away, the medicine down the track is just so painful that it causes massive damage. But so does an overreaction and an overshooting. And we've got all of these messages that are saying, look, overseas we've got a slowdown. We will also get a slowdown if it slows overseas. And if you pile interest rate increases on top of reduced demand from really coming from external sources, I think we'll make our own trouble for ourselves, and we'll have manufactured our own overreaction.
Yeah, I think that's a good point, albeit what's interesting out of China is suddenly they're saying full steam ahead and growth estimates are being upgraded because they're finally coming out of COVID zero. I was interested in the point you made around what is a normal interest rate, because we all got used to sort of quite low rates at 2% and then suddenly 0.1%. You've made the point if you go over 30 years, 4.6 is the average. It is worth noting, though, that doesn't include a period where we had sort of 17% and it was coming down in that period, but it's a very high interest rate. So I guess it leads us to think, what is a neutral setting right now for the economy? Is it somewhere where we are now between 3 or 4, even though that's low by historical rates? Is that the current day neutral setting, do you think, considering how many people have borrowed money and bought houses over the past 10 years at much lower rates?
Yeah, I don't think it is. If you look at the cash rate over an extended period, 33 years, it is 4.6%. Now, I take your point about the 17.5. If you take that out and say, look, let's pretend that was 7.5, you still get to a 4.1% rate. So you know, and is that any less normal than the zero or virtually zero rate we've had over the last couple of years? Well, I don't think it is. I think both are unnatural rates. So it's somewhere in between. Now, the neutral rate is a tough concept because neutral is not the same when you're at 17.5% as it is when you're at 0.1%. But I think it's a fair bit higher than where we are today. Does it mean the Reserve Bank will want to move to that neutral rate straight away? Not necessarily. Will they eventually want to? Yeah, probably.
And I guess that last part is the interesting one. So we all think short term, it's sort of how we're geared as humans, and we go, where's the rate in 6 months? Well, it will be in a year. But if you're thinking about, you know, if you're a home buyer out there or thinking of being one in the next 4 years, you're saying, what, get used to something around 4.6, which, remember, means we're talking about paying an interest of maybe 6.5%, 7% on your actual home loan. That might be the sort of thing we see return to in the next few years.
Look, you've only got to go back pre-GFC, that's 12 years odd ago, and people were paying 8% on home loans. And really 8% wasn't seen as being a super high rate back then. We were used to that. So, yeah, I think people do have to get used to a higher rate and say, well, look, this was a bit of an aberration. We've got to get through the transition now because that's going to be the difficult bit. But once we get through the transition, we will find that we can afford higher interest rates. Will we ever expect them to get back to 0.1%, the cash rate? I don't think so. It doesn't mean it won't ever happen, but I just don't think so. But the Reserve Bank will want to move to a more neutral level so that they do have room to stimulate the economy if they have to, because there is recession either overseas or here in Australia.
Steve Mickenbecker, thanks for your time.
Thank you, Tom.